So basically, it's a real pleasure to see such a diverse audience gathered around a topic that sits at the heart of Building Bridges' mission, connecting capital with purpose. And today's discussion is about investing with impact in African private markets. For those who join us for the first time, we're not too familiar with Building Bridges. It's an initiative that was launched in 2019 out of the recognition that achieving the Sustainable Development Goals requires far stronger collaboration between public, private, and multilateral sectors. Every year in Geneva, we host a flagship event. It brings about 2,000 people every year from about 100 countries. It's a truly global community of to advance sustainable finance and impact investing. Our work doesn't stop in Geneva, though. For the past 2 years, Building Bridges is not only an event, but it has become a foundation. We are a platform for ongoing engagement through partnerships and year-round programming. And Africa holds a special place in this mission. It is both the continent that needs most foreign investments, and the one that is offering some of the richest impact investment opportunities anywhere in the world. That's why we've established a dedicated Africa investment community that now counts over 100 members across Europe and Africa mainly. And through this community, we share news, research, relevant events, connect individuals and organizations that is really at the core of Building Bridges' mission. We host private online gatherings, public webinars like this one today, but we also use, obviously, our flagship events to convene targeted stakeholder groups to advance a specific topic. In addition, and this is something we organized last year as well, we also organized delegations to Africa to provide a robust learning experience and create the conditions for meaningful connections. And in fact, we are going to Nairobi with a group of 20 delegates, with Karen, who is in the call here today as well, to attend the AVPA conference that starts next Monday in Nairobi. Our delegates will have a chance to meet other networks and their members beyond the one that participate in AVPA. And I'm thinking in particular of ANCA, the African Natural Capital Alliance, and AFCA, the African Private Market Association, of which Abi, our moderator today, is the CEO. All these initiatives are designed to build the bridges that enable capital to flow more efficiently, inclusively, and sustainably into African markets. That's really our purpose. So in today's conversation, it really comes at a pivotal moment. Africa's private markets are at an inflection point. When it comes to private markets in general, and as it was mentioned at Building Bridges Summit a few weeks ago, even though there's only $11 trillion in private markets, which represent approximately 12% of the size of public markets, it's increasingly seen as a decisive capital for a decisive decade. So that's one part of the equation. I think the second part of the equation is Africa, obviously. The continent gets only 2 to 4% of global capital investment, despite accounting for 18% of the world population. So here we are today to speak about African private markets, which kind of like brings these two key parameter for change. With a young and fast-growing population, accelerating technology adoption, and urgent needs in infrastructure, healthcare, agriculture, and other sectors, investment case for Africa has never been stronger. And yet, scaling private investment still requires tackling several bottlenecks, such as local currency risk and fragmenting regulatory frameworks, among others. At the same time, smart private investments, especially when paired with venture and blended finance strategy, can unlock enormous value. So that's exactly what we want to explore today with our distinguished panel of practitioners. Together, they will help us understand how private equity, venture capital, and blended finance are being deployed to shape Africa's next growth chapter, and how global and local investors alike can participate effectively. So thank you all for joining us today and for being part of the Building Bridges community. Please let us know where you're joining us from in the chat. And also, if you have any questions throughout the session, we'll pick them up towards the end. So please put them in the chat, and we'll We'll select a few for the panel to address. With that, I'm delighted to hand over to Abby and our wonderful panelists to kick off the sessions today. Thank you very much.
Brilliant. Thank you so much, Boris, for the invitation. Hello, everyone. I'm Abby Mustafa Madwako. As Boris mentioned, I'm the CEO of the African Private Capital Association. I will shortly introduce the panelists who are going to share their wealth of experience with you. But just a couple of words on how the industry has evolved, how the private capital industry in Africa has evolved over the past few years. So from our perspective, when we talk about the African imperative, we're really talking about, and Boris mentioned this, a continent that is at an inflection point. So we all know the demographics, we all know the statistics: young, dynamic population, rapid technology adoption, the ability to leapfrog. But I guess the other side of the coin is the needs of the continent around infrastructure, healthcare, agriculture, climate resilience. And over the past half decade, what we've seen is private capital really playing an important role in part, directing capital towards solving some of these wicked issues that the continent has been facing and realizing the return as a result of that. Just to put into numbers, we've seen over $35 billion of deal activity, so $35 billion of funding that has been invested in multiple hundreds of deals across the continent over the past 5 years. We've seen the growth of a nascent industry to the tune of over 350 active fund managers that are actively investing on the continent. And we've also seen, as is natural, the diversification of the allocator pool on the continent. So what started as a heavily DFI funded private capital industry, well, private equity at the start, has now bloomed and blossomed into a diverse private capital industry, including different asset classes like private credit, infrastructure, venture capital, and also including more diverse institutional investors. And I think the diversity on the panel today is testament to that. So now there are family offices playing in the space. We're seeing local domestic institutional investor participation, albeit not as large as the global DFI participation, but we're seeing diversity in terms of allocator participation. And the last thing I'll say before I hand it over to my panelists is, for such a nascent industry, what's been a pleasure and just amazing to watch over the past few decades is, again, the transitions that we've seen in this industry. So the opportunity is always going to be a consumer-led opportunity on the continent, but we've started seeing investment opportunities across other sectors like renewable energy, climate solutions, digital infrastructure, logistics, manufacturing. I could go on and on. So again, testament to the growing opportunity and the growing investment opportunity across Africa. So for me, I'll close by saying it's an exciting moment for the private markets, private capital in Africa. And our conversation today is about framing that excitement, but in a measured way amidst kind of the risk reward of investing and allocating to the continent, and just understanding, most importantly, how to scale the momentum, I guess, responsibly and collectively. So on that note, really happy to kick off this conversation, and kudos to you, Boris, for putting together an all-female panel. It's amazing. Want to start the conversation by introducing, and I'll let the panelists introduce themselves, but very pleased to be joined by Anne Wyman, Senior Partner at AfriqueInvest, Catherine Kax, Managing Director of Investments at Soros Economic Development Fund, Shruti Chandraskar, Head of Investments, Africa Region at the International Finance IFC, which you all know. So thank you, ladies, for joining. And I guess just to start, I thought it would be useful just to open up the conversation by giving the audience a bit of an idea as to your overall organizational strategy when it comes to allocation for the LPs and when it comes to investments. And I'll start with you, Anne, because AfriqueInvest is a long-standing multi-strategy fund manager. Could you give us just a little bit of color as to your investment strategy?
Sure. Thank you, Abby, and thank you, Boris, and thank you, Building Bridges, and as well, also honored to be here with Catherine and Shruti. It's a pleasure. So I'm Anne Wyman. I am the head of investor engagement at AfriqueInvest. I also wear another hat at AfriqueInvest, which is chief economist. So I think a lot about the the economic and political risks and opportunities in Africa. As Abby mentioned, Africa Invest has been around now for 3 decades investing on the African continent. We consider ourselves basically an investment platform with multiple strategies. Started out 30 years ago in Tunis, which is where I am normally based, with a focus on North Africa. But that investment strategy expanded rather quickly over the next couple of years to include the wider continent of Africa. Today, Africa Invest has a range of strategies that include a generalist set of strategies, both for SMEs and then a separate one for mid to large cap companies. We have a family of funds that focuses on financial services. We also have a family of funds, or we have a fund that is venture capital focused, that's been around now for several years. But over time, we've also expanded where the needs have been called for on the continent. And that includes things like health. So we have a blended finance health fund that provides debt to help provide affordable and accessible healthcare on the continent. We have a private debt vehicle that provides more tailored private equity, almost sort of private equity-like private debt as needed on the continent. We also have a cross-border strategy. So we've got a small team based in Paris that actually focuses on investing in French SMEs with some kind of African angle, whether that be some kind of operations in Africa, exports to Africa, etc. So we look at also the cross-border links that can be built, or the bridges that can be built between the developed world and Africa. And soon we'll be launching also a climate fund that will be looking at several sectors, including the built environment, sustainable mobility, and the agricultural supply chain. So quite a lot going on in our shop, but we think there are lots of opportunities for investment, and we do that with a number of different investment teams, locally based in 9 different countries in Africa.
Brilliant. Thank you, Anne. Great way to kick us off. I'm going to zoom quickly to you, Shruti. IFC, long-standing investor, direct and allocator on the continent, in addition to across emerging markets. So please tell us a little bit more about your allocation strategy.
Sure, happy to. I presume most of you are familiar with the IFC, but for those who are not, we're part of the World Bank Group. And like most of the institutions of the World Bank Group, we fund ourselves through the issuance of bonds. We're owned by 192 countries, so our credit rating is AAA. And so we issue bonds and then we on-lend. So the bulk of what we do is lending in emerging markets to private companies. We, over the years, have started increasing our equity allocations, and we fund most of our equity allocations through our accrued retained earnings. And every couple of years, we allocate a portion of our retained earnings to blended finance pools that we then use in concessional form alongside our balance sheet funding. So that's sort of roughly what IFC does. The portion of the business that I cover is our investments into private equity funds in Africa. We invest across strategies: growth, buyout, infrastructure, venture capital, various early stage seed strategies. So our goal is to enable financing for companies from inception all the way to IPO through partners. And so we invest into funds, and the funds enable us to access companies. We also co-invest with some of our funds directly into companies. And then IFC also has strategies to allocate equity directly into companies. If you look at our allocations on an annual basis, we're roughly between 1/3 to 40% through third parties, so through funds, and then the balance directly into companies. For Africa, we have been investing in Africa since the mid-90s. when we first allocated to Africa Invest, and have been allocating to private equity funds since. We have a portfolio of around 2 billion invested across Africa, or across around 150 funds. Our goal is to increase the points of access for companies to raise capital. So IFC provides capital itself, but if there's only one door that companies can knock on, it becomes not an egalitarian process. And so our goal is to strengthen the financial ecosystems in the markets that we operate by enabling the creation of other financial institutions that can provide different types of capital. So that's broadly what we do. Happy to dive in more specifically as we take the conversation forward. And for all those on the call, thank you for introducing yourself. I'm based in Nairobi, Kenya. So for those of you who are here next week at ABPA, look forward to.
Great, thank you, Shruti. And over to you, Catherine. Could you tell us a little bit about your core focus, mandates, and strategic priorities?
Absolutely. Thank you so much, Abby, and very pleased to be here with Anne and Trudy too. So basically, Source Economic Development Fund, some of you may know us, but for the ones that are not familiar, we are one of the largest philanthropies in the world. I think third philanthropy, George Soros philanthropy, which is Open Society Foundations, SCDF, Source Economic Development Fund, is the impact investment arm of the foundation. So I've been on board 7 years. Before that, I spent 15 years of my life with the Danish DFI, and I'm saying this because, having the IFC in the room, and then we venture over to philanthropy where you do not have to fundraise or deliver a certain return for investors. So we have, as a philanthropic investor, really the ability to lean into risk. And this is what really defines our investment mandate. So we lead with impact, direct, and a certain contribution to systems change. We work very closely with the foundations that deploy in the tune of $1 billion in grant making and advocacy efforts per year. So we really believe that, with private sector investments and philanthropy, you can challenge and try to change systems. We allocate $100 million a year. We have a core focus on WIC Global. So starting with the strategies that are less relevant for this conversation today, we invest in independent media. Everything that promotes open and vibrant democracies and societies is a core mandate with a justice and equity lens. Nature-based solutions, Latin America, and a number of other emerging strategies, but focusing on Africa, we have lately been doing a just energy transition, which is very much energy access. Later in the conversation, we'll touch a bit about how we design our portfolios. We can do all instruments from guarantees, equity. Majority of what we do is through intermediaries. So funds is approximately 80% of our balance sheet.
Brilliant. Thank you, Catherine. I will touch on your impact thesis as well a little bit later. But thank you very much, ladies, for that detailed introduction. I'm sure it was very helpful for the audience. Wanted to start just taking a step back. And Africa Invest, as we've recognized, one of the first private equity back then manager evolved into a multi-strategy manager, as you clearly depicted in your intro. Can you just give us, from your vantage point, how has this industry evolved over the years? What have you guys been seeing as one of the longest standing private capital players in the industry?
Thanks, Abby. I don't want to repeat too much of what you said at the beginning, because you did a great job of, I think, touching on some of the ways that the industry has matured and expanded. Certainly, the different kinds of strategies that are available today are very different than they were back in the early 90s, where we were mostly talking about quite simple, plain vanilla PE type structures. Today, you find a wide range of investment strategies, from VC to private debt. Blended finance is a big buzzword and something that we're doing more of on our side, and I think something that will come in as part of this discussion as we talk about ways forward. But we also, are seeing more sector-specific strategies come in, whether it's in health or education. And so we've seen a sort of a broadening of the different types of investment strategies. We've seen an increase in the size of the geographic expansion that's been covered. That's not just from the African Invest standpoint, where we started out in North Africa and then moved south. But I think we've seen a lot of fund managers diversifying the number of countries that they invest in because there are more opportunities, but also as part of their strategy to hedge risk. And we'll talk about that too. The investor base is diversified. You pointed to this, Abby, about how we were, I think, at the outset, and gratefully very heavily financed by the DFI community, who is still very much a part of our day-to-day investor base. But I think now the diversity of the LPs within the African private capital system has really expanded, whether that's from foundations, family offices, insurance, asset managers. But I think one of the most important diversifications that's been happening over the last couple of years is the increase of local investors into the system, which in a way is what we all want, right? It's part of the holy grail of this ecosystem, is that it could be locally funded one day, which will help to increase its sustainability. And then maybe one other thing that's worth mentioning in terms of changes or developments, I think when we looked at the way that investments and then exits were made back in the early 90s, it was quite traditional, exits to strategic investors, IPOs. Today, we're seeing many more different ways to exit because liquidity is such a premium, whether that's secondaries, exits in multiple tranches. I think fund managers these days are being much more creative and thoughtful about how to generate liquidity for those who are investing in their funds. And I think that's a positive development in the industry as well.
Sorry, I was on mute. Thanks for that. And I think on that liquidity theme, I'm just going to move to you, Shruti, just to get your perspective, because there's a global liquidity crunch for obvious reasons that we can all acknowledge. So from your perspective, how do you think the fundraising appetite from an LP perspective has changed over the past few years?
Hi, Abby. Fundraising for Africa is very tough. So if you look at capital raise, and this is your data that I'm going to reference, in 2013, 2014 timeframe, I think the industry raised $4.5 billion. And last year, the industry raised around the same amount of money. So in 10 years, we haven't really grown in terms of being able to attract capital to Africa, right? Which is very unfortunate. I think a part of it is the point that you made on liquidity and the availability of liquidity in the market. And the lack of exits and time horizons growing. Some of those trends are global. Some are more specific to Africa. But the LP appetite, if you sort of to break it down and say, have the streams of funding changed? I think DFIs have sort of consistently been there, very much driven from a development goal. I think in terms of the mix of the private capital that's flowing into Africa, that mix has changed over time. I'd say around 2013, 2014, you saw a lot of private allocators allocating to Africa. So the large fund of funds of the world, the HarbourVest, et cetera, allocating to Africa in terms of looking for the next new growth story. So we'd seen China go through the early aughts, you'd seen India starting to emerge. And so as part of that wave of allocating to emerging markets, you saw allocations to India grow, Indonesia grow, various parts of Southeast Asia, and you saw allocations to Africa grow as well. Those commercial allocations have fallen away. You're not seeing sort of global allocators allocating to Africa as part of an EM strategy as actively anymore. But where you've seen sort of growth in allocations, I'd say are two pockets. One is local capital, So we have seen a meaningful growth in allocations from local pensions. I mean, we always saw this in South Africa. There's a vibrant local LP universe that are allocating to South African funds, but we're starting to see an increase of local capital allocators in Kenya, Nigeria, Ghana, where pensions are trying to diversify, sometimes driven by the fact that they were over allocated to Treasury, and Treasury hasn't seemed or behaved as secure an asset. In other places, just seeking diversification as assets under management grow. So we've seen meaningful growth in the local capital space. You've also seen an increase in allocators allocating with an impact lens. And this is something that it has existed in some form, I'd say, over the past 30 years in Africa. But I'd say now you're seeing a growth globally in allocations on an impact lens. And you're seeing allocators starting to realize that, if you're measuring the impact achieved per dollar, and you're to measure that for Africa, your effectiveness will be that much higher because the need is so large. And so the second sort of group of international LPs coming in to allocate to Africa is coming from pools very similar to what Catherine manages. And, it'd be very interesting to hear Catherine's journey in terms of her allocation story. But I'd say those are sort of the changes that we're seeing in LP appetite. In terms of like the focus of strategies, Africa historically has always been a growth story, right? People allocating to Africa are primarily allocating to finance growth of companies. You do have a buyout piece of the market. It is very small. And usually, even in the buyout assets, there is capital going in for growth because the buyout is primarily around succession changes that, it's a family that doesn't have a next layer of family members who want to run the business. So, you're seeing succession planning in a different way and a buyout investor enabling that. But primarily, the thesis that you're financing is not a cost arbitrage that you would see in buyout assets overseas. It's very much a growth story. So I think in terms of allocation, it hasn't changed that much. We saw like a jump in VC in 2019, 2020, but it's the technology trend has stayed, but the VC bubble, has shrunk a little bit. But all of it, if you look at what is being financed, it's growth.
Thanks, Shruti. I think it's a perfect time to bring you into the conversation, Catherine, and you teed this up for me nicely, Shruti. So when we look at the capital spectrum, there are things that, as Shruti's mentioned, IFC can do. And then there's almost a bit of a gap where SCDF can come in and add that complementarity. So I suppose my question to you, Catherine, is when we think about your impact thesis, particularly how you identify those gaps that I just mentioned, how does your capital complement what DFIs and other development finance institutions are doing, like IFC? Where does your capital start and stop?
So I always want to take a step back, Abby, and look at the kind of, the larger funding gap. I think that now we are all acknowledging that ODA is shrinking. So the pool of grant, very concessionary funding that was available for funding on the continent, taking on the risk, is, being reduced. I think we also see in the MDB, DFI space, that some of the DFIs have funding from governments, which is also being impacted. And I'm mentioning this overall kind of this framing because, the issue and the billion of dollars that are needed to fill the gaps and, create the growth can no longer come from, the concessionary pools as catalytic capital only. If you look at philanthropy, then we, of course, have an increased role to play in terms of catalyzing in, trying to de-risk, bring more private capital in. But I think this is also a moment and a call for all of us as investors and you know, to DFIs, to MDBs, to ourselves, I think when we look at the opportunities in the market, and there's a wealth of them, it's to decide to take on, you know, the appropriate level of risk. I would really want to see that more private capital, domestic capital, to Shrudi's point. We've seen that in South Africa. I think, you know, the pension fund market in Nigeria has also been there, but really accelerating domestic capital. So I think we can come in and take on very junior first loss positions when it makes sense. I know we may talk about blended finance structure later in the conversation. I think, you know, there's also something to be said there. But I would also say that if you look at the set of opportunities, when you get to the scale and the growth equity, we also must acknowledge that, you know, exits have been sometimes challenging. So there's a role for private capital, including the capital that SEDF has, to come in at the more kind of growth equity stage. So we, and I think this is again creating a, you know, pipeline of bankable projects, seeding locally led VCs, and then creating those exits in the market.
Just going to ask you a follow-on question, Catherine, because you started alluding to the role of philanthropic capital being catalytic and de-risking, and we're going to talk a little bit more about risks later. But just wanted to understand from your perspective, what has been the most effective? How has concessional capital been the most effective in unlocking follow-on investment from your experience? What have been the most effective strategies or features that SEDF has supported to put in place to further unlock more, whether it's private pools of capital to come into the space?
I think there's a number. So if you stay on the blended finance, there's one initiative that we helped to launch, and that is called Allied Climate Partners. So it's basically a consortium of philanthropic investors that have created a platform, a vehicle that can come into early stage climate finance with first loss capital. So, and there's been engagement, in addition to that, really engaging with the DFIs so that the senior stacks of the capital are ready more or less to come in when the junior stake is in place. And I think what we often see, Abby, is that if we can over-engineer blended finance structures at, you know, smaller fund size, where it just takes a very long time for them to basically be finalized. And I think that's one of the issues. So when we see that it works is that, or basically there's a speed to action, is when we engage the full group of investors with different risk appetites early in the process, so we don't end up negotiating different terms, etc., and where it takes, you know, up to 1-2 years to basically finalize.
Thanks, Catherine. And I'm going to start with you, and then Shruti, if you could answer it as well before we close this segment of the discussion. What do you think? Because you've each individually mentioned local capital a lot, so great to see that there's a recognition that local capital is coming in. You've also both mentioned things around blended finance, but what do you think are the most critical levers or enablers that would scale private capital impact in Africa? Is it, you know, more local capital? Is it, you know, blended finance structures like the one Catherine just described? Is it improved exits like you talked about? And what, from your perspective, if you could synthesize into 3 top things, what would they be? And I'll start with you, Anne.
That was for me. Sorry, I thought you said to Catherine and Shruti. I would say blended finance is certainly one of the most important ways forward, where we are more able to adequately put together the risk appetite of a given LP or investor and their expected return or impact expectation. And that work to do that work, and we've done it in our Transform Health Fund, where we've put together catalytic investors and commercial investors together, and given them their sort of appropriate risk, adjusted return expectations in the way that we've set up the waterfall. We're doing that also in our climate fund. And I think that's one of the key ways that we can, create an ecosystem that functions better for the needs or more fit for purpose. I did mention local capital. I think local capital is important both for long-term sustainability, but also when we think about this point about foreign exchange risk, there's still a lot more work to be done, but thinking about ways in which we can pull together local pools of capital in local currency, making investments in local currency where we remove the FX currency risk. And this is a structural challenge because some of the best fund strategies are multi-country. So you're talking about putting together disparate pools of capital for different markets. But I think thinking about new ways of structuring funds that will allow us to take advantage of these growing pools of local capital that are willing to come in and invest in longer term in the private capital industry will be important ways to sustain the industry.
Great, thanks, Anna and Shruti. Over to you. I know for IFC, capital mobilization is an important part of your strategy. What do you think is going to be the most transformative lever to scale private markets in the next 5 years?
I mean, I'd say three things, right? One is if returns improve, the funding will flow. So I'd say that's the first one. It's a hard one, but it's the first one. And then if you unpack that a little bit and look at what is the biggest reason why returns when you invest in private assets in Africa don't compare with those in other markets, it's currency volatility, right? And so that second piece, if you're able to structure local currency funds, and your investors are local currency investors, you've taken that away, right? So if you so for instance, in South Africa, where the market's more evolved, evolved is the wrong term, has been around longer. You'll see South African managers raise two parallel vehicles, a dollar vehicle for dollar investors and a rand vehicle for local investors. The rand vehicle doesn't have to think about currency mismatch, right? And so we are in situations where the dollar funds are not hitting carry, but the rand funds are hitting carry. And so if you are able to build an ecosystem with local capital funding local companies, you take that challenge away, right? And you'll often see very established blue chip private equity firms from Europe or the US come to Africa and then really struggle because they're not used to this currency mismatch. Like if you're a US private equity fund, you're raising in dollars, you're investing in dollars. Whereas in Africa, that's not the case, right? You're raising in dollars and you're investing into companies that are operating in local currencies. And so I think local capital local LPs will help change that conversation. And I think the third piece, because you still want to mobilize overseas investors, is blended finance. And I think, blended finance is still very young in its journey. I mean, the blended finance principles only came about around 2017, 18. So it's very young as an industry. So there's a lot that can be done with blended finance. We're still in a test and learn mode in terms of what works, what doesn't work, what actually mobilizes private investors, what doesn't. And so I think there are a lot of tools in the toolbox that can help us mobilize more money. And there are different ways this is being done, right? I mean, if you look at the Altera announcement that Abu Dhabi made to invest in climate funds, I mean, it was a phenomenal allocation to move money into impact asset class. Yes, it was global, it wasn't Africa specific, but those type of strategies around blending capital can move Africa in a very meaningful way. So, it's we're thankful to see players like Catherine do more in Africa and, her peers as well as the industry grows. Catherine, I don't know if you wanted to add to this, but I teach you.
Yeah, no, happy to, if okay, Abby. So I think it also I completely agree with Trudy that blended finance is it's pretty nascent and it's still being tested, and we've not yet seen what really works well and what doesn't work well. And I know, the concept about blended finance is it's all about really trying to attract, de-risk, to attract more capital, to scale, and ultimately achieve more impact. But I think, building a bit on the point that I made before, I think we can try to simplify in terms of investors. And I think that if you look at on the continent, clearly there will be some sectors. If you're doing high risk energy access, recently, announced in New York Climate Week, the Acumen Hardest to Reach Fund that is part of that is doing off-grid solar in some of the more challenging nations. You need blending to de-risk. You need grant funding. You need TA to kind of seed and build out the ecosystem and potentially subsidize. Initially, that makes a lot of sense. But I think what we've seen from SCDF side, and I think we've invested this year in 7 funds across Africa, from early VCs to growth equity, and what we've seen is that in some structures, if you have a fund that is $70 or $80 million in size, and you've got like 3 tranches, that becomes very complicated. So again, and I think wanted to make two other points is that in terms of what we're trying to solve for, sometimes on the investor side, I think we're trying to de-risk or really trying to solve that equation that it is almost like we kind of, not forget, but I think the focus on what is really important, like the underlying strategies, needs to be elevated. But still think that there's a lot to be done. And I think that what we also see is that the private sector, local pension funds have probably like less of an exit. They can be more patient in exit in terms of if we can provide a more utility style, return that is like a minimum.
Great, thanks, Catherine. And we've heard risk quite a few times, so I'm going to zone in on a couple of risks and move it over to you, Anne. So a lot of the risks that come up when people think about investing in Africa, some is perceived, some are real risk, currency and political. So from a risk management perspective, how does AfricaInvest approach currency and political risk across your multi-asset platform? Because these risks, they don't only have an effect on your portfolio, they also have an effect on exit planning and liquidity, which we've heard is very important. So how do you approach this from your side?
I think that's a really important question. And I think you hit the nail on the head by indicating that there is real risk and there's perceived risk, and we have to be able to recognize the difference. But certainly when we talk to investors, and new ones in particular, we have to put ourselves in their shoes and understand that they come to the table sometimes with perceptions of risk that may not be the same as those of us who've been sitting and doing this for 30 years on the continent. And so I think the first step is just recognizing that not everyone has the same perception of risk and being open to understanding how that risk perception might be brought to the table at the beginning of a discussion. Secondly, we address this through boots on the ground. So AfricaInvest, we're more than 100 people, but we're spread across 9 different offices on the continent and then 2 others. And so for us, a lot of it is the touch and the feel, the local knowledge. I am the firm's chief economist, but I hand the mic over to all my colleagues in the local offices to talk when we talk to investors about what the risks are, because they're better in touch with it. And I think there's nothing replaces being on the ground and being in the environments to be able to speak to what it feels like doing business in X or Y country in Africa. I think we also, from a kind of a strategy perspective, when we think about investing, we ensure that we have diversified portfolios. So all of our fund strategies are Pan-African now. We used to divide ourselves back when we first started in between Maghreb funds and Sub-Saharan African funds. We've done away with that geographical difference, and now really think that the best way to focus or to mitigate risk is to not overly invest in any one market. We don't do any country-specific funds anymore. We also think it's important to focus on export-oriented companies. So giving access to hard currency for many companies, I think, is one way to help mitigate FX risk. Also focusing on taking companies regional, so they are operating in more than one country. Single country exposure is, even within the portfolio for a single company, is also something we try to avoid, though sometimes you can't in very large markets like a Nigeria. And then there are tactical kind of, you know, specific to an investment type of hedging arrangements that we might do if the opportunity arises. So, for example, we made an investment in Nigeria in Just Right, and decided that a supermarket chain. And before the investment was made, there was, I think, a very strong feeling that a devaluation was coming. So we structured our entry into that investment by borrowing in local currency for a while before going in with the actual hard currency investment, just to be able to get over the hump of the devaluation before it happened. So if we can foresee or think we can foresee an opportunity, the reality is that when you're talking about private equity, it's too long for a hedge. And even if you could, you know, the hedges aren't available. And even if you could, they'd be too expensive. So this is, I'm really talking about very tactical type of operations, but we do have to be on, you know, on the outlook for that. So I think it's a, you know, multifaceted approach to taking on this currency and political risk.
Thank you, Anne. We've got a couple of questions coming in, but before I go to those, I'm going to quick fire because I really want to get Shruti and Catherine's perspective, because the whole point of managing this risk, as you've so well articulated, Anne, is so that you can have optimal exits. So you manage your risk properly, you create value, and then you have the right exit. So moving to you, Shruti, I'm going to ask you a rudimentary question. Why does IFC care about exits at all? So we talked about liquidity throughout this discussion, but why is it important to IFC as a development finance institution?
I'd say a couple of different reasons. The first one is we want our capital to continue to be productive, right? So if the capital never comes back, it never goes out again. And so, you know, I know there's been over the past decade or so a lot of, you know, conversation and discourse on patient capital. And I think patient capital is needed, but I think the challenge is when you don't have capital moving, then you're not funding anything new. And I think that is the primary reason why we're looking for exits, so that there is capital flow. And if there's no capital flow, you don't see new investors coming in, right? And so we want the overall market to grow. We want more people to allocate to Africa. And the only way you're going to be able to allocate more to Africa is if there's movement of capital. And so I think that, yes, you know, things can take a little bit longer for different reasons, but the reason why we care about exits is to have that circularity of capital. I mean, you know, if you're thinking about what is the best investment, if you have a company that has an ever-growing EBITDA, you never really need to pull your money out and reinvest it, right? Especially if it has an ever-growing EBITDA margin, if you're thinking purely commercially. For IFC, what we want to do is build financial ecosystems, enable financial inclusion, create jobs, build the overall economic infrastructure. And you can't do that if you park money in an asset and you never able to sort of get that money circling in the market. So that's the reason why exits are important for the market as a whole, to sort of underpin the economic growth that we need to see.
Thanks for that, Shruti. And Catherine, I'm going to ask you a more specific question. How important, when you're evaluating fund managers in general, how do you evaluate their exit strategies? Because Shruti's framed why it's important for exits, you know, just recycling of that capital. But how do you evaluate their exit strategies? Are you flexible around the timing or the structure during transition periods when you're trying to balance financial discipline with continuity in ESG outcomes?
Yeah, so I mean, we care a lot about financial sustainability because, you know, medium longer term, that is linked to impact. To be honest, we're less concerned about the exit horizon, and because we've got patient capital. And I also think that there's a bit of, you know, the private equity model works sometimes, but not all the times. And I saw that William Brent from Husk put in the chat that what about the innovation? So hi, William. I would say that, you know, we know the issues. So, you know, you mentioned it earlier, Shruti, that you've got, you have some managers that have performed very well or satisfactory in local currency, and then you translate it into hard currency, and it kind of, there's no DPI. So I think we just need to, so looking at upfront at the exit strategies of managers, of platforms, or when we do direct investing, it's to also be, you know, look into a bit of innovations or trying to see what is it that doesn't work and what can we do to solve it. And with that said, sometimes it may not make sense in all industries at early stages to set up vehicles that have like a steep exit horizon, maybe a more like kind of platform structure. You can always solve for exits, you know, cash for redemptions gradually, etc. So I think for us, that's most important, because by the end of the day, if we are, you know, pushing managers to exit in unfortunate, sometimes tough, non-lucrative markets, it's not beneficial for, you know, any subsequent fundraising, attracting further capital, but nor for the impact. But I think from our perspective, again, we're a patient investor, and we recognize that some managers, it has been not their exit strategies that has not been good, but it's been macroeconomic volatility that have caused it. So we really want to hone in on that when we look at fund managers' previous experience that they come with.
Abby, maybe can I come in on just a new tool, just to follow in on Catherine and answering that question from William. One of our funds, our SME fund, which the IFC is an investor in, has a more innovative remuneration structure for the fund manager, which is meant to incentivize impact. So in fact, rather than the typical type of carry structure with a hurdle rate at the typical 8%, there are incentives set in the hurdle structure such that it is reduced based on meeting certain impact targets that have been pre-agreed and spent a lot of time pre-agreeing what those were, and incentivize the fund manager, that is us, to hit impact targets such that we are able to hit carry at an earlier stage or at a lower hurdle. So I think these types of innovations where we align, you know, fund manager incentive, reality on the ground, and kind of a realistic expectation of what kinds of returns can be expected in Africa, in hard currency, in, you know, certain areas like SMEs or early stage. I think that's the kind of tools that we need more of, is you know, putting realism together with incentives, incentive structures that make sense for the people who are investing.
Thank you, Anne, for sharing that example. William, I hope those answered your questions. Shruti, did you want to add to that?
Yeah, I mean, I'll just add a few things. I mean, I think one of the challenges, I think, with how we financed assets in Africa is we've taken mechanisms that work in markets that are much deeper, financial markets that are much deeper. And we've tried to sort of impose the same criteria and guardrails in Africa, and both positively and negatively, right? I mean, in the number of businesses that we saw in the venture space that have raised a ton of money from like 2017 to 2022. We'll focus on you a little bit later. Sorry, we have a visitor here. Yeah, I can. So if you look at, I will, but let me just finish my. If you look at, you know, the model that was taken was a California model of success in the venture space when there was a ton of capital available, and it was where people were making money, you know, as companies grew and valuations grew, you know, maybe not fully justified. And we took that exact same model to Africa, valued companies the same way, and that type of money is just not available anymore, right? And so there was a lot of money that was maybe spent in a manner it shouldn't have been spent, right? And there's a whole host of companies that have shut down because of easy access to capital for a certain period of time. And this idea from California of growth at all costs, right? Africa is different. You have to think about how capital is available here and how it needs to be used. And I think we often forget that. And so I think that the need to innovate should be more from a lens of, is it going to work on with the realities of what we're seeing on the ground, as opposed to, you know, this is a model that people are familiar with overseas, so let's implement it here. There are like innovative ideas coming out. And the second point that I'll make is we're very focused on private equity here, but the financial systems are large and wide, right? So we've seen a reasonable amount of innovation around, you know, outcome bonds, outcome-driven payments, where you are capitalizing the impact that needs to be generated alongside return, right? So I mean, some of the things that the World Bank has done is a lot of sustainability linked bonds or outcome bonds. The most recent one that we did is we issue a bond, let's say 4%, you take around 0.5% off of that return, you swap it out to its net present value, you invest that into an additional project that generates positive impact plus return, let's say a project that generates carbon. And so someone buying a vanilla AAA rated bond is now getting bond plus positive impact, right? And their returns might actually be higher than your standard AAA returns. So I think there is innovation happening. It's happening across the board. There's innovation happening in the private equity space, but there's a lot of innovation happening. And I think we need to think about solutions that work for Africa, specific to Africa, not necessarily because the solution worked in California, it's going to work just as well in Africa.
And can I just add a 30 seconds point to that? So it's just about, you know, innovative financing, because I think we also, as investors, need to be really realistic. If you look at, you know, like again, the energy sector, maybe there's a bit of over indebtedness, right? And there's nobody that wants to come in with equity because it cannot be priced enough or high enough for the risk. But then there's new structures coming up, like kind of receivables financing that is off-balance financing. So I think from our perspective, it's also really looking at the sector, the industry, the need in terms of instrument, and then coming in with that. So I think being a little more sophisticated instead of just, you know, saying now we're going to go in with equity, but we're really trying to kind of diversify as well as in terms of what works for the industry.
Great, thank you all. We don't have time for, well, any more questions, but I'm just going to ask this one quickly because we're talking about innovation, we're talking about what needs to happen, but layers up from that, before that can even happen, is we need to raise the attractiveness of investing on the continent. I think that is the primary thing before we talk about the mechanics and the innovation needed to address some of the key challenges on the continent. So a question from Kathleen was, how are your organizations working with regional development banks like AFDB to enhance the market attractiveness and raise investor confidence? So maybe not AFDB specifically, but how are you thinking around working on increasing market attractiveness and raising investor confidence? I'm going to start with Anne.
Yeah, I'll maybe answer that because I'm going to shine some light on you, Abby. And I think, you know, using AFCA and the African Venture Capital Association, which is a great industry association and helps get the word out for all of us, is a really important way of showcasing without us having to do it and sort of tooting our own horns, because of course, that's part of my job in investor engagement, but I'm biased towards my own firm. And it is the impartial industry associations like AVCA, like GPCA, that can help us to get the word out, and some of the regional ones as well. And they're great aggregators of data. Then they have a lot of impartial data that, you know, runs across the industry. And I think that's really important way, because nothing speaks like the numbers to help give people confidence and root their opinions about the continent in real numbers.
Great, thank you, Anne. I'm afraid that's all we have time for. I saw a couple more questions afterwards, but apologies. The conversation was so rich. Thank you very much for the discussion, Anne, Catherine, Shruti. It was great talking to you all. Just to summarize, I think what we've learned today is the industry has evolved significantly. For the next phase, blended finance is going to be quite an important tool. So is the participation of local institutional investors. Thank you, William, again for your question on innovative ways, because I think it unlocked a new part of the discussion around things that are already being done that are quite innovative to not only attract capital, but also to invest in the key sectors of the economy. So thank you all very much. And I'm so sorry we're out of time. I know there was lots more to cover, but hopefully you can engage with the panelists either virtually, or if you are in Nairobi next week, you can reach out to Shruti at the AVPA.